Welcome to Revere Asset Management's Your Money with Danny Stewart
The market will always overshoot to the downside and to the upside.
and Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep. No Danny Stewart this week. His daughter's getting married. Congratulations goes out there. But you got the B team in the main seat again today. And we will, of course, wrap up the show with a special guest appearance by Dan's voice. I wouldn't deprive anybody of that. But quite a market we've got going on here. I don't think it's an exaggeration to say that this week has been one of the most difficult weeks for growth investors from a standpoint of, we always say the market will try to separate you from your positions and do the best job that it can. We've had a lot of underperformance over the last 2 weeks by some leading names. We've got some comments on YouTube that I'll address related to that. But that final shakeout for growth stocks seems to have happened Wednesday morning, Wednesday early afternoon. And then the market, as it always seeks to fool the masses, with a gap up on Thursday and a follow-up gap up on Friday. Today, October 24th, it is 11:41 Eastern Time, and the S&P 500 and NASDAQ 100, as well as the Dow Jones Industrial Average, are sitting at all-time highs. And we talked several times in the past. One in particular was February, March of 2021, where growth stocks completely came apart. This was due to a spike up in interest rates, a breakout in the 10-year. The indexes were mostly unaffected, but small cap, mid cap growth completely taken apart. That ended a very strong, almost 1 year rally post-COVID in 2020 and into 2021. But we've seen over the last couple of weeks some really devastating moves in some of the leading names. We'll take a look at a few of those charts, but let's start by addressing this question that we had up in YouTube. So first, I'm going to bring up the trend gauge. Anybody that follows our videos is very familiar with this. At end of day Wednesday, when we did the video, we had some in-house debate about whether or not we should go to just a red arrow on here on leaders, or just go with the neutral arrow and the red sub arrow. We decided on the neutral arrow and the red sub arrow. One of those reasons was it looked like it might have been, we got shaken out of a bunch of our names. So really the last thing that you want to do is put in the bottom by going max to a maximum bearish position. And also want to point out that there are really 6 stages that we go through with something going from a green arrow, which is growth or uptrend, to a red arrow, which is protect or downtrend. So obviously the best case scenario is no sub arrows and a green main arrow. Then we start introducing yellow sub arrows if things start to deteriorate. Eventually we'll go from, that's like the first step down. That arrow moves further to the left. That would be a second or third move down. And then if you go to just the neutral arrow, that's really 3 changes, 3 steps down. Then we start introducing the sub arrows. That could be the 4th or the 5th step down. And then by the time we get the red arrow, that's really 6 degrees of changes going from the green arrow to the full red arrow. So the comment that we got on YouTube, little bit of saltiness in here, but that's all right. We'll take it. The comment said, I think your market gauge isn't suitable for the growth portfolio at all. Most growth and turbo stocks are already down 20+%, and it still shows yellow. Come on, when's it going to be red? After a 50% drop? And a subscriber chimed in accurately. I would guess there's a forgetting window where former leaders no longer contribute, especially after removed from the leaders list. That's a very good point, because once we put up a 21 over 21 and a Turbo 12 leaders list every Monday, and it's kept the same throughout the week. And it's our way of tracking deterioration throughout the week, or strength throughout the week of our individual growth names. We did see all but a handful break the 21-day moving average by the end of day Wednesday. But at the same time, other names had been coming off over the past 2 weeks. But we easily had a list of 21 quality names that still held above. They weren't on the list because we don't update it every day, but they stayed above their 21-day moving average. So the red arrow on market leaders is really not a prediction of what we think it's going to happen. It's a reflection of what actually is going to is happening between the leaders that we have on the 21 over 21 list, leaders that aren't necessarily on the 21 over 21 list. For example, we're not going to put 6 crypto miners in there and 3 quantum stocks. We're going to have one of each, and let that leader represent what's happening to the overall sector. So we're not denying the fact that crypto miners, quantum, gold names, a lot of AI data center power names absolutely have been underperforming and gotten hit very hard. But we don't just focus on those. We keep at least 10 to 12 sectors in this leaders list to give us a broad list of what's going on in the market, and also to recognize the sector rotation that's going on in that leaders list. For example, we had one oil stock in there. Oil stocks have acted extraordinarily well over the last week. They're not necessarily growth leaders, but if that's what's leading the market, we're going to point it out and we're going to track it. So our follow-up comments to this was, Ted, was it you did the video on Wednesday, right? Or was it Connor? Who did it last night?
Yeah, I did the video. I did the video Wednesday.
You did. Okay. So Ted said, you're right. The market gauge isn't just a gauge of growth leaders, but overall liquid leaders of the market, including other sectors besides growth. And that's the point that Ted was trying to make, or support what I just said, that we've got 10 to 12 sectors in there, not just 3 or 4. So thank you for tuning into the video and your question. Very kind way to answer that. My response was kind of what I just kind of indicated. It said there are 6 levels of downgrades using the sub arrows to go from green to red. We've gone through 5 of them. I can list off 25 tickers still above the 21 EMA, while others have been crushed, and we've discussed these in the video. Each ticker has its own stop. The gauge is not a stop for all tickers. So you can't just take a look at what does it say for market leaders and say, that's it, I shouldn't own them. You have to look at the individual tickers that are in there. They all get their own unique stops. This is the hardest of the 4 arrows to point out. We do tend to stay more on the bullish side for market leaders, as long as there are 21 reasonable names that are staying above the 21-day moving average. So yeah, we're not denying that some have been absolutely destroyed, but those are no longer leaders. You have your individual stop for that. That comes off of your leaders list the same way it comes off of our leaders list. And we talk every night in the video about what's working and what's not working. So that's our kind of our mailbag for the week. What else did we want to go to? All right, so I'll just go to the indexes now. And a week ago Friday, Ted in his video drew this line saying decision time was coming, and it certainly was. We were in a triangle there. That's a consolidation. Consolidations, as to keep the trend in place, consolidations should resolve in the direction of the primary trend. Obviously, you can see that the direction of the primary trend was up. And that's what we got on Monday. When I did the video on Monday, I talked about this breakout. We added some exposure on this breakout. We had a very nice tight consolidation day on Tuesday, very bullish. Wednesday's candle here doesn't look bad at all. But if you look at FFTY, which is one of the components of our RG8, this is really not good. And it reflects IBD 50, reflects what's going on with 50 leading stocks that are in that index. That was a much harsher break that showed up on this chart than it did on the NASDAQ 100 and the S&P 500, which both held their 21-day moving average. Dipped below it for about an hour or two intraday and got back above it by the end of the day. Let's take a look at a 60-minute chart of FFTY, and you can see that's a pretty big pullback even for a growth index from above 41 to maybe 36, 40-ish. That's a double-digit pullback in about 5 days. But let's take a look at the S&P 500. It's not even something that you think happened. We pulled back here. Let's go to a 5-minute chart. This is why we keep this S&P 500 core position very important. Here's the pullback in the S&P 500 during this harsh sell-off on Wednesday in growth names. We rallied into the close, cut the overall loss for the day in half. The 21-day moving average is right around here. Regained that by the end of the day. Tight. Here was the tight day that got us pretty bullish on Tuesday after the follow-up to the breakout on Monday of that triangle. Little bit of volatility on Thursday, but then Thursday afternoon, we broke out of the opening range, made a higher high, not an all-time high yet, pulled back a little bit into the close, and here we are on Friday. CPI came in cool. Market gapped up. It's holding the gap, and we're sitting here now at all-time highs on the S&P 500, the NASDAQ 100, the Dow Jones Industrial Average, small caps, not quite, but close. Maybe an all-time closing high by the end of the day. Probably won't hit the all-time high spike up from the week prior. What's left? The mid-cap index. This is the laggard. Not all-time highs. That's back here in November, but approaching recent highs. So back to the S&P 500, back to the triangle breakout. They're never going to make it easy. Thursday was Wednesday was a shake the tree day. Undercut intraday on the indexes. Much worse. Let's look at ARK-K2. This is the other one that we track. Closed below the 21-day moving average. IWO, another component of the RG8. This is our 8 growth ETF composite, closed below the 21-day moving average. I think all components of the RG8 closed below the 21-day moving average that day. Here's SPHB, undercut it, but didn't close below it. And you can see that's at all-time highs now. That's S&P 500 high beta. So the bottom line is the market did a hell of a job of shaking out growth investors. I'm going to go through some of the charts. We got stopped on a lot of positions in-house, and then the market pulled a complete about face on Thursday, acting as if the devastation never happened, and then following through to the upside today. Some of these growth names just pulled back and held their 50-day moving average. This was a big talking point that we had Thursday morning on our morning call about how, a bunch of them broke the 50-day moving, 21-day moving average, but just bounced at either the 10-week or the 50-day moving average. It's very clear to anybody that knows the O'Neill system that a pullback to the 10-week in an uptrending growth leader is a buyable event. We added on Thursday back to hood, some of the hood that we had sold on the way up or on a break of the 21-day moving average over the last week and a half. Also on Thursday, we saw a big gap down in Tesla on its earnings report, put in the low right away and rallied throughout the day back above the 21, back above the 8. Very strong day. IBM also reported that day. This is not a stock that was on our radar at all because of the lame growth numbers that it puts up, but it gapped down 8%, touched the 50-day moving average, and look at that move from 265-ish to 307. It's on our list now, folks. Action like that. They also have a decent quantum exposure. Let's talk about quantum for a little while. Here is one of the biggest quantum names, IonQ, got absolutely destroyed from 84.64 all the way down to 50 and change. It's bounced back a little bit over the last couple of days, but a lot of these are broken and really do need some more basing, no question about that. But at the same time, you've got other growth leaders that had held up well and broke out on Thursday. Here's CrowdStrike for an example. Very nice cup and handle. Went sideways over the last month. Brief undercut of the 21-day moving average. Breakout on Thursday. Zscaler, another breakout in the same industry group. So let's go back and go through a couple of these 2121 names, and you can see how some did get destroyed. We held on to 4. Grotection held on to 4 names. I believe Turbo had 4 names left as well. You can check Thursday night's video to make sure. Here's NVIDIA. Had been tight for 2 weeks, holding up while the growth names were getting devastated. Briefly took a dip below the 50-day moving average, but regained the 50 and the 21 and is breaking a little downtrend line here. Halliburton was the oil stock that we bought in Grotection on Tuesday, on Wednesday, followed through on Thursday, inside day today, acting very well. That was it, besides the ETFs. And again, I'm going to stress, the exact reason that we maintain this core position in the S&P 500 is to catch these rotation days. Money didn't really come out of the market hand over fist on Wednesday. It went out of growth names and it went into value names. Nail, we own this. This is a play on declining interest rates. We're seeing that. We're seeing some decent action from some of the home builders trying to put in a bottom. We added to this today also. Snow got stopped out of it more as a defensive market. I broke my rules on this. The first half broke the 8 EMA and I went red on it, so I sold that. I was still positive on the first buy and it bounced off the 21-day moving average, but because of the carnage I was seeing Wednesday, it shook me out of this last small piece of Snowflake. Now I'll look to add it back, and if I do, I'll be adding it back at a higher position, a higher price, but I'm okay with that because I know how this action tends to play out when the market shakes people out of their names. Micron, an absolute stud. This is an example of one of the 25 that never broke the 21-day moving average, making a newer high today. SanDisk is another one, looks fantastic. Mongo never broke the 21. CrowdStrike, already talked about. AMD, another leader, never touched the 21, now making an all-time high. So you don't have to focus on the names that are getting destroyed. Focus on the names that are holding up. Your stop will take you out of the names that are getting destroyed. Your stop will keep you in the names, if it's not broken, that are holding up. Alibaba shake below the 21, regained it over the last couple of days. First Solar shake below the 21. Cleveland Cliffs, this was one that reported earnings. They said they're going to get into rare earth mining. It had a big gap up. Monday, by the end of the day, we had it on the 21 over 21 list. Tuesday, it had a big negative reversal on an analyst report saying that this stock is now a sell. That was a complete overreaction, and it's not making any progress. And if it won't, that'll get taken off of the list at the end of the week as well. Palantir, another one that shook below the 21 and the 50-day, but held the 50-day and is now gapping above this most recent trend resistance that formed over the last 2 weeks. LITE, Turbo added to this today, and or TED, I'm not sure, one or both. But look at that gap up out of a very tight multi-week base on above average volume. This was in the 21-21 list, another one that held up just fine. Briefly undercut, but closed right near the 21 on Wednesday. Back above it immediately on Thursday, new highs on Friday. SoFi held the 50-day moving average. WGMI, this is Bitcoin miners, harsh sellback, as they all did, but one closed below the 21, regained it on Thursday, back above the 8 on Friday. We're looking at this to buy. EQT, an oil name, not holding the 21. MP Materials, massive shakeout on this, from 100 all the way down to a low on Wednesday of 66. That's a massive pullback. That's over 30%. Just struggling to maintain the 10-week moving average. This is one that probably needs to base. Let's look at NBIS. I just got an upside alert on this. Another one that broke the 21, bounced at the 50-day moving average, regaining the 21-day moving average today. Let's see what else. GDX, big harsh break, but held the 50-day moving average. Very similar to gold. Bloom Energy, big multi over 20% pullback from 126 to 88. Do the math. That's over 20% pullback. But regained the 21 yesterday, breaking back above the 8 EMA today. This has been, like I said, a very difficult week for growth investors. Here's Credo. Tight action for 3+ weeks. Several closes below the 50-day moving average. We took a position in this in Grotection, got stopped out on Wednesday, made a fool out of us. It's at a higher high now. If I buy it back, I'll be buying it back at a higher price. And again, I'm okay with that because something has changed in the market over the last 2 days. We went from growth leaders being weak to growth leaders having a renaissance. Those that showed relative strength are breaking above multi-week resistance. Don't argue with that. LEU is another one that had a brutal pullback. Now it's back above the 21 and the 8-day moving average. This is an alternative energy nuke play. The nuke plays got nuked, but they're making a comeback now. So that's where we see things from where we sit at Revere. The index portion that we keep in the S&P 500 as a core in all of our portfolios has helped to buffer the pullback. The pullback for Grotection was a little over 2%. For Turbotection, it was between 4 and 5%. Those are paper cuts. Very easy to regain those when the strength comes back into the market and growth stocks start acting the way we want them to in a healthy market. And it starts with a review of the trend gauge in every video. Thursday, last night's, we took the red off. Today, a green sub arrow will go back on, and then we'll reevaluate next week. Again, multiple steps going from growth to protection and then back towards growth. This sub arrow has been all over the place over the last 2 weeks. You can see on 10/16, this was over a week ago, we downgraded market leaders from green to yellow, and then we use the sub arrow to let the viewers know which direction growth is leaning in. Early in the week, it was a green arrow. By Wednesday, it was a red arrow. By close of business on Friday, unless we give up all these gains, it'll be back to a red sub arrow. And then it will evaluate the strength of leaders and determine when to go back to the green arrow for market leaders. But we've had green arrows for the indexes across the board, pointing the divergences with the yellow sub arrow on short term as equal weight and mid caps have been lagging. But solid action above the 50-day moving average and the long-term 200-day moving average, not even close to being touched. So a lot of people say that they're bottom-up investors. They look at the stocks first. Others say top-down, I want to know the overall picture. We're a combination of both. We consider the indexes. We consider the individual growth names because there are times when leading stocks are ahead of the indexes. There are times when the indexes survive better than the leading stocks do. And this is version 4 of the Grotection rules that we're on now. Version 5 is going to include some changes when it comes out next year. But every change that we made to the rules was a lesson that we learned from something that happened in the past, and is going to try to improve our returns for our clients, not based on our opinions, but based on the facts that we have learned from years observing the indexes and how leading stocks act under different market scenarios. So that's my opening monologue. If you have any questions, please include them in after we post this on YouTube later this afternoon on Friday, and we'll be happy to address them. And now I'm going to turn it over to the fellas for their individual segments. We're going to start off with Connor. He's going to talk China, and I'm going to bring up a chart of KWEB. Take it away, Connor.
Yep. So doing a segment on a little bit of a different sector. Obviously, everyone can see the leaders in our 21/21 list, but I did want to talk about China today, and Don's got a chart of KWEB up right now, which is just the broad ETF for China stocks. And as you can see, they are reclaiming the 50-day and the 21-day moving average. And if you go to a weekly chart, Don, you can see that, for a while, China has not been doing a whole lot. It's been in a huge stage 1 base. And then this year has been kind of the stage 1 base breakout. And the group is in a stage 2 uptrend now. And since this move earlier in the year, this has been the first pullback to the 10-week moving average. And like Don mentioned earlier about leaders, a William O'Neill principle is typically the first pullback to the 10-week moving average is a great buy, as that still means that it's potentially early in the cycle of the move and that it could have a lot more room left. And there's some volatility going around with China and Donald Trump just going back and forth talking about tariffs. But again, this pulled back to the 10-week moving average and it held quite nicely. And it's showing great RS lately. And actually, China's outperforming the Nasdaq in the last 2 years on a percent performance basis. But so that's the weekly. If you go back to the daily, and again, this is just crafting out quite nicely. Looks very good. And as long as it holds the 50-day moving average, expectation is that this continues higher and shows some relative strength. They are having a meeting next week, next Thursday, I believe. So that could be a catalyst in either way for China to move higher. So that's KWEB. Now you can go to BABA. We own a position in TurboTex in this one, and if you start on the weekly chart, very similar to KWEB. This has been very strong. You can see this big stage 1 base breakout, very strong run up, and again, first pullback to the 10-week moving average since stage 1 base breakout, and it got supported, which is offering a good risk to reward. The move started, if you go back to the daily chart, the move started on that earnings announcement from BABA. They had some really positive commentary about their cloud growth and just AI in general, and that prompted the earnings gap. And then you got that really nice strong run up the right side, and a little bit of volatility, but again, not too out of the ordinary of a pullback after a strong move up. And then again, similar as KWEB, this found support at the 821 50-day, reclaiming it today. And this one looks good for continuation. And then more of a choppy one, just to mention, BIDU. This one also fits the bill with, AI and just China tech in general. This, when this stock moves, it can really move. And you can see it went on a super strong run, similar to Alibaba. Now it's pulled back to 50-day moving average. It's building a decently tight range here. Still has that 21 days overhead. And, the weekly looks a lot better. Perfect test of that base breakout level, holding the 10-week moving average. And again, as long as those lows hold and the 10-week moving average these look good for continuation. So those are the main focused areas in China. There's some other ones like Futu, a little bit more choppy, but when I think of investing or trading China, BABA, BIDU, and the ETFs are the best ways to play it in my view. As you know, BABA and BIDU, they have the liquidity. They're just much larger market cap names, less prone to big gap risk. And then KWEB as well as the ETF. That's a very good one as well. So those are the three main charts. And then Don, if you just bring up some of those charts I shared on the EPS growth and CapEx. And then yeah, I've found this chart pretty interesting. I was reading it this morning, and you can just see massive earnings boost from AI CapEx is underway based on this chart, and you can see the S&P 500 tech chart that if this comes to fruition, this has a lot of room higher to grow. And then the other chart is just the EPS growth. It is expected to accelerate 12%. This is driven by AI, innovation and going global. So those are some other things to stack the odds in your favor. But those are just, China ETF looks good. And then two names that we are stalking and trading for this sector. And plus, it can be good diversification as well, not having all the portfolio in, AI data center names. So can act as diversification as well.
This KWEB, what an extremely low risk entry point on this, and we constantly are looking to put the risk reward in our favor by using a very small R. Your R is the amount that you are putting at risk for your initial entry, and then we track the R multiple, which is the number of times the gain that you were risking to get your gain. So R1, if you were risking 6%, R1 would be plus 6%, R2 would be plus 12%, R3 would be plus 18%, and just keep raising your stops using moving averages and/or resistance levels, possibly do some offensive selling if you get too far extended. Offensive selling really helped us over the last week when a bunch of these names that we were in got just way too extended to the upside. They're not going to run forever. And IonQ is one in particular that MP was another one that we did some offensive selling on. They just don't run forever. And when they're this volatile, talking about an ATR that's 8, 9, 10%, and the group goes out of favor, look out below, because the hedge funds don't play around when they sell. Thanks, Connor. We're going to take it over to Ted, and we're going to take a look at three names that are forming bases that he is pretty excited about. Take it away, Ted.
Yeah, thank you, Don. So I just wanted to talk about three bases. Some are shorter, a few weeks, 4, 5, 6 weeks long, and then TMDX is really multi-month. You can even call it over a year-long base. And so I've talked about this on the podcast before on the I believe it was May 2024 earnings gap, and that led to a very big move. And at the time, TMDX before the gap, actually not that one, Don. This was the 2025 one, the 2024 one. This was over a year and a half ago on the podcast.
All right.
And at the time before the gap, it wasn't liquid enough, so that is why we didn't buy it for clients. But after the gap, I guess institutions saw value in this name, and now the average dollar volume is liquid enough for at least turbo. And this formation, this chart pattern right here, is quite typical of names before they start new stage 2 uptrends that potentially can lead to big moves. You have a huge downtrend, which we saw, then a huge basing period. Then you had that earnings gap that Don pointed out in May of 2025, and that was a double beat and raise. Really nice earnings and numbers. You can see the green line on the chart is accelerating as well. And in a second, I'll dive deeper into the numbers. And now you have this really symmetrical, clean base. When you look at it, it's just clean. The pullbacks are clean, respecting moving averages, and you have a previous uptrend as well, and a really linear one. That's exactly what we like to see. So if you go back onto the daily, you have all key moving averages aligned now. It actually uh, started to move here a little bit, up 10% in the last few days. But we do have earnings looming over us next week. So the key is earnings, and we'll have to find out and see what happens there. But in terms of quickly what they do, for those that haven't been tuning into the podcast for over a year and a half, they just have this organ care system that helps transport organs for organ transplants. And organ transplants are in high demand. People are on wait lists for years for a liver transplant or a kidney transplant. And and the next problem is transporting those organs to the hospital, to the surgery room, uh, in a safe way, in a healthy way for the organ as well. And with legacy technologies, many of those organs are unusable by the time they are received at the hospital. So TMDX is solving that issue, and they have definitely raised efficacy of the transportation, and they're seeing it in their earnings, adoption, and numbers as well. So in Q2 2025, they saw 179% growth. I'm not sure if the numbers are exactly the same, but I'm using deep view numbers and I can't really see it on market search. But they saw 179% growth, flipping positive from negative 64 cents the quarter before. And they're seeing 4 quarters of sequential earnings acceleration as well. And the future estimates are massive too. In terms of revenue, they're also seeing accelerating revenue growth in the last 4 quarters with 56% last quarter as well. And annually, they're seeing acceleration as well, turning from a losing money company into a making money company. And the earnings are supposed to, according to estimates, flow in more and more over the next few years. 2025 estimates for this year supposed to end at 130% growth. So really great numbers from this name as well. And there's no return on equity in market surge, at least breaking it down quarter by quarter, but they're also seeing acceleration from 12.5% return on equity in Q4 2024 up to 48% return on equity in Q2 of 2025. So that just shows that the business is increasing their efficiency as well. So that is the first one. Really excited about this. And I was really excited before over a year and a half ago, but this enters stage 4 decline. So really took my eye off. And the big lesson here is even if you're bullish a story and the fundamentals of the company, which has been continuously growing, I'm only really interested when the chart starts telling us that it could potentially head higher or give us the best probabilities of riding a smooth trend. And that is perhaps right now, but it'll come down to earnings next week. The next one, Don, is LITE. This one is also a lesser known name. So before talking about the chart, which is actually breaking out today out of a 4 or 5 week flat base, what they do is in data centers, all the chips, all the data need to be connected. And so they're in the optical and networking as well as photonics industry. And to break it down in a more simple way, so they have a segment of their business for power, AI, data centers, and they'll make these special light switches that help services like ChatGPT, Netflix, and cloud storage move massive amounts of data at lightning speed. And then they also create industrial lasers too, which is not really in the AI space, but it's for like cutting metal and for medical devices as well. And so a big part of their business and their moat is their artificial intelligence and machine learning infrastructure with data centers, connectivity. And again, we've seen the mass amounts of demand for data center infrastructure. And so the main thing they're benefiting off of is the 10x fiber requirement increase for generative AI applications that really has taken place over the last few years. And looking at their earnings as well, just triple digits earnings, future estimates as well, accelerating growth in earnings, and then quarterly sales, mid to high double digits more recently at 56% growth in Q2 of 2025, and they're expected to continue to accelerate in the quarters ahead. And quickly on the technicals, just broke out today. You can see the relative strength line also made a new high, confirming the strength. And I believe someone did a RS line segment. It might have been Connor a week or so ago on the podcast. So we're seeing this play out in real time here. And that's just further confirmation. And the final one, everyone knows this name. I did 2 small names with TMDX and LITE before, but this is a mega cap Google. And although they are, I think, $3 trillion market cap company now, they're not slowing down with innovation, that's for sure. And we don't really need to talk about the legacy part of Google's business. They're one of the biggest money makers in the world. I believe at one point, or they still are, the company that generates the most free cash flow, and that's why they've just been a compounder over the decades. But the end factor here that we're looking at, and part of the CAN SLIM acronym, the N is really big as well as the M, is the convergence of AI, their own in-house hardware called TPUs, their quantum chip, and as well as autonomous driving. And we recently, actually Google, a catalyst today was Anthropic partnering up with Google to use their hardware, their TPUs, to run their next, or to train their next generation of Claude models. And Google, as well, as we all know, have their in-house Gemini model as well. And there's just a lot of positive things or catalysts going on for Google, as well as tailwinds. One of the most important thing for Google is that they attract some of the best talent in the world. So in the last couple of years, Google researchers have won 3 Nobel Prizes. One is in their AI department, Google DeepMind. And the CEO is Demis Hassabis, and he won the 2024 Nobel Prize in Chemistry. So when you have all this talent, it's obviously going to lead to breakthroughs in some of the biggest sectors of innovation in the world right now. And that AlphaFold AI model pretty much helps predict protein folding. And that's really key in chemistry and biochemistry, as well as drug development in the biotech and biopharma space. And then another scientist actually that won it this year, Nobel Prize in Physics, contributed to the developments of their Google Willow chip, which is in quantum computing. And it's a lot of jargon, but he demonstrated whatever macroscopic quantum effects mean, but that essentially enabled them to create their Google Willow chip. And then finally, the godfather of AI, actually, who developed neural networks, won the 2024 Nobel Prize in Physics. He actually left the company and starting to become an AI doomer, since he thinks AI is going to end the world. But that's a story for another time. And besides all of what I just said, they also have Waymo, which is arguably the leader in robotaxis or autonomous vehicles right now. We'll see how Tesla catches up to them, but Waymo is definitely the most established in multiple cities at this point. Like millions of miles driven by the car itself, robots with 4 wheels. And so that's really the convergence here for Google. And they have earnings coming up next week as well, which will really be key for the overall markets too, since they're $3 trillion market cap and a huge player. They're a hyperscaler in AI.
All right, Ted, great stuff. Google just a few months ago, back in April, the quote unquote conventional wisdom was that Google search was being replaced by AI, and there were some stats that came out that their advertising was being impacted because they weren't seeing the click-throughs, because when you go to Google now, they generate an AI summary of what your question is. So people were just looking at that, not going down to the click-throughs. That theory, you always got a thesis, but then you got to have price that goes with that thesis. That actually put in the bottom, and look at how it's run from 150 now to above 250 since April. Just phenomenal strength for a big cap stock like this. Good stuff, Ted. All right, we're going to wrap it up with Todd, who's got some interesting insight into IREN and some competitors of it. Take it away, Todd.
All right. We talk about data centers all the time, and there's so many different data center operators out there. But I really wanted to key in on what I believe is the best growth leader in data centers, although it's had a massive run this year, and Turbo traded it extremely well. Toddzilla traded it extremely well. We're currently out of it. But I want to kind of talk about why this one in particular, I believe, is the best of all the data center operators that trade right now. And first of all, let's do a quick introduction. This company's really at the intersection of three themes: clean energy, Bitcoin mining, and AI infrastructure. And if you look at really what data centers are doing and how they've developed, they've all been scrambling to adapt to AI's explosive computing demands. And many of them have converted from Bitcoin miners to data center operators. What makes IREN particularly interesting is they were built from day one to be both. They weren't a Bitcoin miner converted to a data center AI processing operator. All their data centers were built to do both Bitcoin mining and AI compute. And the biggest thing is, when you look at why these data centers are emerging as big operators now, number one, there's a huge shortage of power. Okay. Data centers by 2030 are supposed to use over 9% of all power generated in the United States, currently from around 3% of total power. So power demand is growing exponentially for AI compute. And there's a massive shortage of this power. The big advantage that IREN has is it took anywhere from 2 to 3 years for a company to get connected to the grid once they start building the data centers. Now, if you want to build a data center, it's going to take 5 to 7 years to connect power to the grid. So if you're coming on board now without plans, it's going to take you 2 to 3 times longer to get the utilities to hook up your data center, where all of IREN's data centers and their data centers in production now are already contracted out with the power operators. And number two, they are a low cost user of power. All their power is renewable energy. Okay. Their data centers are in 2 locations: West Texas and British Columbia. The West Texas power centers or data centers are all powered by solar and wind, and their Canadian data centers are all powered by hydroelectric. And their average cost across all the data centers is 3 cents per kilowatt hour. So they have a tremendous advantage from the power standpoint because these are very power hungry. And finally, I mentioned how all their data centers are dual purpose built to mine Bitcoin and process AI. The other companies are pivoting from Bitcoin mining. A lot of them built their data centers in shipping containers or retrofitted warehouses. All of IREN's data centers were engineered purely for data centers. So they can take the power, the cooling, the configuration, and they're much more efficient data center operators. Now, if we quickly go to their chart, I want to point out one major thing amongst all these data centers. This company is highly profitable. If you go to the weekly chart and if we look at their earnings and sales growth, they've had triple-digit earnings and sales growth, and they've been profitable since 2025. And they've got everything we look for in terms of the triple-digit earnings and sales growth. I just want to compare that. Not that these are bad stocks or anything like that, but CoreWeave. Let's take a look at CoreWeave. CoreWeave is still losing money, okay? They're not expected to be profitable through 2026, okay? The chart doesn't look bad. It's nothing compared to IREN. It's pulled back, spent a lot of its life below the 50-day moving average, retested the 50-day moving average here recently and is bouncing much more choppy. They're a big leader in data centers, but they do not have the low-cost electricity like IREN does. If you want to look at one final one, NBIS. This is the big European data center operator, another one that is not making any money yet and not profitable. So again, not a terrible looking chart. It's reclaimed its 21-day moving average after bouncing off the 50-day moving average. But if you look at all three charts, NBIS by far is the strongest, both in profitability as well as the chart pattern. If you look at finally going to IREN's chart, all it's done is break its 21-day moving average for one day, held and bounced off that 21-day moving average. So by far, the relative strength leader, the profitability leader, the best position for sustainable, vertically integrated growth that combines cheap renewable energy with the profitability of Bitcoin mining and the ability to service AI cloud demand. So just demystifying the data center operators, this is the one I believe is the best growth one of them all.
Great stuff, Todd, and the numbers don't lie. That's very clearly profitability on IREN. Compare that to NBIS. Their losses accelerate next year. They lost less in 2025 than 2024. 2026, they're going to lose 3 times as much as in 2025. That's not a guarantee that the stock is going to underperform. We ultimately go by what price is telling us, however, and I don't think you can argue with when you're taking a look at two companies and one is much more profitable than the other, which one the institutions are going to flock to. Hard pullback, certainly, for both NBIS and IREN and CoreWeave during this downturn, but one closed below the 21. Despite that harsh pullback, that gives you some good perspective as how extended it was to the upside, and nice profits cashed on our Toddzilla. Toddzilla is a portfolio that Todd's running. When we make portfolio managers prove themselves when they come into Revere before they start managing significant amounts of client money. So Toddzilla is a test portfolio. Ted and Connor did the same thing before we launched Turbotection. The more managers, the better, because there are always going to be some that are hot, some that are cold, and you average it out, it gets to a smoother equity curve. Great stuff, Todd. That is going to wrap it for this week's podcast, and I will send it back to the spirit of Dan to close the show. All right. If you like what you heard, tell your friends, tell your family. There's a reason why we call the show Your Money. That's because it is your money, not their money, your money. We'll see you back here next week, because it's not how much you make in the markets, it's about how much you